Welcome to Investing 101. This is the 5th class in a series. Check out the playlist to find the previous and the subsequent classes. Today we're going to be talking about price charts, market depth, trading volume, types of trades. We'll talk more about the kinds of risk and how you mitigate them, and we'll show off Investopedia a bit again so that you can use a simulator and experiment with some of these new types of trades and charts and things. So to start off with, this is a price chart. You may have seen something similar. This shows just about all the complex features that you might see in a price chart, so we'll go over each one of them. This is representative of a bunch of different types of things. This could be a stock, this could be a mutual fund. In this particular case, it happens to be cryptocurrency, but that doesn't actually have to play into this at all. What we see here, price chart will typically have a zoom factor. So this up here is showing us that every one of these, what's called candles, are representing 5 minutes of time, one after the other. So we actually are just looking at several hours of a day in this case, so a little before 6 to around 1 p.m. And we see that this security, or cryptocurrency, is quite volatile. It goes up and down a lot. Of course, it's common for things to go up and down throughout the day and week and year. Cryptocurrencies are particularly volatile, which makes this an interesting price chart. And these bars, roughly, if you just squint a little bit, you basically see a line going up and down and way up and then down again, and that's basically the price throughout the day. If you want to get more technical and more detailed, you can, which is like this. The rectangle that you see in a candle, or you could call it the wax, the candle, I suppose, represents the range from the opening and closing price. So when this 5 minutes started, the first price that traded during this 5 minutes was right here at this price point at the bottom of this wax here. And then it shot up in those 5 minutes and ended those 5 minutes at this price. Because it went up, this candle is green. When the price goes down, the candle is red. And this rectangle here means that the first trade during this 5 minute interval actually started right here, and then it fell during those 5 minutes, which is why it's red again, down to this lower price point here. Now, if this 5 minutes is right next to this 5 minutes, how is it that they're not connected? Why didn't the closing price equal the opening price, for example? Well, trades are discrete. Like, there's a trade and then there's the next trade, and the trades can change prices over time. If we look at the trade history, we can see there were several trades for 96.25, and then the price dropped to 96.14 for the next trade. So there are actually discrete drops or gains. And so what you're seeing here is there was a trade that closed here, and then the very next trade was literally down here. So they don't have to be continuous, basically. Now, the little thin lines that extend beyond the rectangle in one or both directions. So this rectangle only has a line coming down. This rectangle has a line going up, but this rectangle here has a line going up and down. Those lines are called wicks, and they represent the full range of trade prices during those 5 minutes. So it's one thing to say, well, the first trade happened at this point, and the last trade happened at this point. But in between the first and the last trades, there was quite the range of trade prices that actually exceeded the opening and closing prices. So it opened here, and maybe during those 5 minutes, the price actually went up a little bit. And during those 5 minutes, the price also went down quite a ways. And then by the time the 5 minutes were up, this was the last trade here. Okay? So again, that's really technical. You generally don't need to understand that to do trading, but some people find that interesting. Another interesting bit is these bars down here, they represent trading volume. So when the price was skyrocketing up here, there was high volume of trading. Probably people got excited and a lot of people bought. you know. And when the price doesn't move so much, I imagine we'll see the trading volume not be so high. So whenever there's a huge price change, you see volume going up. And that's because when the price, well, now let's talk about the order book, which you can also see here. And that'll help you understand why trading volume goes up when the price changes. Here's the order book. You can see on the green, these are offers to buy. And the red is offers to sell, okay? Their prices on this go up as you go up here. And the prices here go down as you go down here. So the very best offer is 96.13 or 14. You know, as time changes, these offers change. And so you see that the very best offer is somewhere in the range, you know, it changes between 96.14 and 96.09 or so, okay? Now, the very last trade was 96.24, and that's what's displayed up here. When you look at the ticker tape and it says, hey, Microsoft is offering, or Microsoft is trading at a particular price, what they're talking about is the last trade price for that particular security. But it doesn't mean that it's necessarily going to be the price you get. Because, for example, if somebody wanted to sell their stock right now for this, well, or this particular security, they would have to accept a price of 96.14 because that's the best offer there is right now. And so the price would have dropped. You would have posted a red 96.14 up here. And that also assumes you didn't want to sell more than 8.6 shares of that security because the 96.14 offer, when it comes back, this is a little animation with several frames in it, only offers only offers to buy 8.6 shares of them. So if you had 10 shares, guess what? You'd have to sell to this 96.14 offer, and you'd have to step down and accept an offer for 96.12. And again, it's animated, so it's jumping around. Apologize for that. But you know, there's some people who are willing to offer a lot, some people who are willing to offer a little bit less. And so if you have a lot to sell, then you have to take several buyers at a time to get rid of all of what you've got, which actually means when you sell several shares, you don't have a single price. You've got several prices that you're selling for. Now, typically at a brokerage, they will tend to report one price, which is the average price, the weighted average of everything you got. So the order book represents, it also kind of represents liquidity of that particular security. All of these people have offers to buy, which gives you the liquidity to sell at any time and get cash out of it. So that it's actually something of a service that they're performing by making offers. Now let's take a look at the red here. Let's say you want to buy a security. Well, if you want to buy it, again, you're not going to be paying the last ticker tape price necessarily. You're going to be paying what someone's willing to sell for. So although the last trade was 96.24, the lowest offer to sell you is at the moment 96.26. So it's a couple cents more than the last trade. So let's say if you want to buy, you could buy up to 51 shares in one of these frames for 96.22 or so. Beyond that, you'd have to crawl up the order book and pay increasing amounts of money. So if I wanted to buy 1,000 shares of this, guess what? I'm going to be climbing from here to somewhere probably around here. So I'm going to be paying for 96.60 for the most expensive share that I buy. And then presumably the last trade would be 96.68 or something posted up here. The spread, that's the distance between the best offer to buy and the best offer to sell. So they're saying, why aren't trades happening? Like, trades aren't posting here. Why? Because there's a 14 cent or 12 or, it keeps jumping, but there's a spread between the best offer. And because if these two order books were to come into contact, if the spread was 0, that's what's called a trade. When there's an offer to sell and an offer to buy that overlap, then the market will execute that trade and both entries from the order book will go away. Although it turns out only one of those orders ever make it to the order book. The order book is made, let's talk about how do things get on the order book? How do people provide liquidity and just kind of sit there waiting for a trade? Well, so far we've kind of been talking the simplest case for a trader, which is a market order. A market order, you'd say, I want to buy 1,000 shares, okay, of something. In this case, it's not showing shares, it's showing how much you'd want to spend, which is a little different, but usually you'll see on a portfolio, you'll say how many shares of something you want to buy. If you're trading stocks, if you're trading mutual funds, you're just going to put in US dollars like it shows here. But when you place a market order, the point is it will execute immediately or as soon as the market opens, in the case of the stock market where it's only open for several hours a day. So if you say, I want 10 shares of this stock, the market will crawl up this order book all it has to until it secures 10 shares of stock, and then you will pay the price that each of them require to get it. And if you want to sell stock, again, if you say, I want to sell 10 shares, it's going to crawl down this order book until it finds enough people who are willing to buy 10 shares, and it will accept whatever their offer was. So that's called a market taker. You're taking entries from the order book in order to get your trade done. Then there's market makers. These are the people who put entries into the order book so that others can do a market order or limit order, whatever it is that they want to do. But you get onto this by doing a limit order. So if you click a limit, if you change this from market order to limit order, not only do you get to say how much you want to spend or how much you want to buy, but you also get to indicate the price that you're willing to pay or the price that you're willing to accept, depending on whether you're buying or selling. So I could say, I'm willing to sell 10 shares of this particular security, but I won't take less than $100. Well, then that would put me on the order book on the sell side, and I'd be beyond this particular view. I'd be way up here at the 100 price point. So if somebody really wanted to buy a lot of the security and they crawled all the way up here, they'd eventually get to my offer and they'd pay me $100 per share, while as in that same trade, others only got $96 per share. Now, most often, as you can kind of see, some of these numbers just kind of bounce up and down, they don't disappear. People don't often make very, very large trades. So the way my offer for $100 per share would actually be executed is more of a gradual change. So you notice, I mean, in here, it's gradually going down or it's gradually going up. As the price changes gradually, this order book, you can sort of see this as a magnifying glass, and it kind of moves up. As more and more offers to sell get taken up, the price generally goes up. Or if more people are willing to sell than buy, the price will generally go down. So that's a little bit about the order book. And limit orders, as you can see, are very common. If everybody did a market order, there wouldn't be trades really much, because you've got to set a price that you're willing to sell for somebody else to. So there's a lot of people and a lot of computers that just post a bunch of limit orders, which provide liquidity to the system. And what they're doing is trying to stabilize the price. Well, they're effectively stabilizing the price, and they're trying to buy low and sell high. And effectively that stabilizes the price because, again, if nobody placed limit orders, the price would just swing totally wildly. So it's a great thing. For you and me, though, who trade in reasonably small amounts, market orders generally are a fine way to go, particularly when the market is open and you can see, okay, I'm going to get roughly 96.24, and you can place a market order and you'll get more or less, you might get 14 cents more or less than that or so, but it's not significant. In a market with adequate liquidity, you can safely place a market order. However, and this is especially true about cryptocurrencies, in some markets, the liquidity isn't there, which means that the order book is nearly empty. And that's very dangerous to place a market order in. I once saw a cryptocurrency market that, for a particular cryptocurrency, that only had 3 orders on the order book. And the prices varied wildly, and they weren't large offers either. Like, it wasn't, I'm offering 60 shares, it was like I'm offering 2 shares or 3 shares. And so if I had placed a market order for 5 shares, I might be taking all three of those orders off the order book and paying wildly different and crazy insane prices. So if you were going to get into a high risk environment like cryptocurrency, you really want to pay attention to the liquidity before you place a market order. Or even safer, limit yourself to limit orders. Now, limit orders don't mean you don't get a trade right away. It just means you're setting your limits. So, for example, I could place a limit order right now for this. If this is trading at 96.24, I could place a limit order that says I want to buy this security and I'm willing to pay up to $97. Well, guess what? If I just want 2 shares of Zcash, in this case, well, there's plenty of Zcash available for less than $97. So although I set, this is important, although I set my limit to buy for $97, that does not mean I will pay $97. That means that's the most I would pay. The market is smart enough to not charge me more than I have to be charged. So if I said I wanted 2 Zcash for up to $70 or $97, I would just take the lowest price, and they'd give me 2 Zcash for $96.25. That's how this whole thing works. So you can put limit orders to buy for much higher than the going price, and you can put limit orders to sell for much lower than the selling price, just to protect yourself in case all of these suddenly disappeared right before you clicked buy or sell, and then you'd end up paying some wildly crazy price. Limit orders is kind of a security blanket of, okay, I know it's going to be this or better. So, and at that point, if you did do something that exceeded the expected price, even though it's a limit order, you're still a market taker, because your order doesn't go to the order book. You immediately take from the order book and execute the trade. There's also there's mixes too. If I said I want to buy, I'll pay up to $97, but I want 10,000 shares, then I would be a mix of a market taker and a market maker, because I would take all of these entries on the order book that you can see on the view right now and a few more. But at the end, I wouldn't have been able to find more than up to 10,000 shares for $97. So maybe I'd get 2,000 shares for up to $97, and then it would stop. Like it wouldn't trade anymore, but I'd still have 8,000 shares left to buy. So that at that point, my order goes onto the order book as down here as the best offer, and it would stop at $97. It would say $97 for 8,000 shares, and the best price that I could buy would be something above 97. It would be 97.05 or something. So at that point, this would be dancing at 97.05. Mine would be at 97 at the very top of the buy list. And that's how the market would stay until someone who was willing to sell was willing to come down to my price. Or other people, and this happens a lot, other people say, oh my goodness, the price went up to $97. I guess if I want some, I have to raise my offer price. And so some of these buys below me would end up that they'd change their limit price to be something over 97 in order to get past me, in order to actually get the trade done. And because I've changed the public perception of, well, it's worth $97 now. So other people would just be willing to pay more for that. Now, another view of this same data is a market depth chart. You still see the trade history here. You still see the order book on the left. But instead of seeing prices over time, what you're seeing is a graphical depiction of the order book. So right here in the middle, that's the mid market price. That's going to be close to what the last trade price was, but not necessarily the same. And then as the price goes up, more and more shares are offered for your taking. Or as the price goes down below the mid price, more and more are willing to buy that price. So sell price goes up this direction, buy price goes down this direction. So you can see at a glance, hey, if I wanted to, not really that you might not make this decision this particular way, but you can ask the question and get an answer. If you wanted 400 shares of this security, here's the 400 level over here, you'd know that the price would have to, for the last share, would have to go up to about $96.50. Okay? Whereas right now it's just $96. And if you had 1,000 of these to sell, and you wanted to sell them all and find out what your price would be, to get to 1,000, you'd have to go to this price here, 96.50. Sorry, 95.50 right here, more or less. Okay. Now there's these really tall cliffs. Those are where there's a whole bunch more volume available at the same price point. So it looks like around 96.50, a bunch of people are willing to buy. If the price were to fall to 96.50, the price would have a hard time falling below 96.50 because there's so many people willing to buy at that price. So that's where where you hear market analysts talk about there's support at this level and there's resistance at this level. So right now at the scale that we're looking at, I mean, you could zoom out and see a much bigger scale of this graph, but at the scale we're looking at, we could say there's price resistance at 96.70 here. It's not, the price of this commodity is not likely to go up above 96.70 because so many people are willing to sell at that price. So in order for the price to go up, more buyers have to be willing to pay a price than sellers. That drives the price up to get more sellers to satisfy the buyers, right? Well, there's a ton of sellers at this price point. So the price won't go up unless enough buyers actually can consume that entire jump. And similarly here, there's a lot of people willing to buy if the price falls to a particular point. So as the price falls, and it would fall because sellers are, eager to sell, there's price support at this level and at this level that will slow the price fall down and possibly just stop it, and then it starts to go back up again. So that's price support and price resistance that they talk about. But again, at this level, you can see just by the volatility, it moves so quickly. When they're talking about price support and price resistance, they're usually at a much wider level, and they're seeing much, much, much larger cliffs. So we've talked about market and limit orders already. Now we'll talk about stop loss and limit stop loss orders. So let's say you bought 100 shares. Well, let's say you bought Intel at $100 per share one day, and you think it's going to go up. That's why you bought it, right? But you're afraid it's going to fall, and you don't want to lose everything if Intel were to, say, go out of business or something like that. More likely just that they announce it, they issue a press release with new revenue estimates, and it's much lower than before, and so everybody decides that, well, a lot of people decide they want to sell Intel and the price drives down. And you're concerned about losing your money. So you can't use a limit order to solve this because the price is at $100. Now let's say you decided if Intel ever fell to $90 and I've lost faith in them and I want to drop, I want to sell my position. Well, if you placed a limit order to sell for $90, it would sell immediately. Because a limit order, remember, it will execute the trade as soon as there's an offer that's within your limit price. Well, if it's trading at $100, that means there are offers for $100. And if you say, I want to sell and I'll take a limit of $90, then it's going to sell immediately because it can sell for higher than that. So a stop loss order is a market order with a trigger. A stop price is what they call it. When the price reaches the stop price, then it places a market order. So you can create a stop loss order and say Intel stop price $90. And that means that if Intel ever fell to $90, it would place a market order and get rid of what you own. Now, remember what market orders are. There's a little bit of inherent risk to market orders in that you'll take whatever price is available. Well, if the price were to fall from $100 to $90, who says it's stopping there? What if the price is falling to $80 or $70 as well? And these trades happen in split-second time. So if the trigger says, well, the price crossed or met 90, sell now. Well, it might not have stopped at 90, right? The best offer at that point might be 80. And so you didn't get $90 per share, even though you set up a stop loss order for 90. You got 80 or whatever the best price was. And if the best price was 30, crud, your stop loss was intended to keep you from losing a lot of money, but you lost a lot of money anyway because the price tanked so badly, so quickly, Now that's just one hypothetical situation. Stop losses exist, and there may be times when you want to set up a price where you'll sell everything regardless of what the price you can get for it is. But you can mitigate this risk by using a limit stop loss order, which is a stop loss order. So it's got a stop price, it's a trigger price, but instead of placing a market order, it places a limit order. Now, I said earlier that a limit order doesn't work. Well, that's because the price already was trading above what the lowest the stop price. But when you set your stop price to 90, you can set your limit price to whatever you want at that point. So you could say 80, you could say 95 even. At 90, when the price falls to or below $90, the trigger is activated. A limit order of say $85 is placed, which means you will now want to sell your Intel stock for as low as $85. Now, if there are still offers for $90, you'll get it. You'll get those $90 right now. If it has fallen to $87, you'd get $87. But if the price had fallen to $82, you won't sell all your shares. Instead, that limit order will still be on the order books, and so if the price fell sharply past $90, past $80, you might have sold some of your shares, the ones that you could sell for above 85, but not all of them because the price kept falling. And then when the price recovers to 85, the rest of your limit order will be filled and you'll get your money, but you'll get $85, even though your stop price was set for 90. Now, if the price never recovers, if Intel were to say go out of business, well, you had that limit order that wouldn't let you sell it, and so that just goes to zero and it never recovers because the company went out of business. So none of these, market is inherently risky. There's no guarantee you won't lose all your money. And particularly when you're dealing with stocks that could, which are inherently a riskier asset than, say, mutual funds and other things, then it's possible, even with stop loss orders on that you've placed, you could still lose a ton of money or all of it. But it significantly reduces your risk. Most of the time, if you're buying and holding a security, hopefully that company isn't about to go out of business. But there's no guarantees. So let's talk a little bit more about risk. We'll start with the costs and returns of risk. In short, you pay for returns with risk. In general, there are absolutely exceptions to that, but in general, that's what you'll find in the market. So if you want a risk-free investment, you can expect very low returns. In fact, negative returns. This is your checking account with a balance that's within the FDIC insured limits, for example. That money's not going to go away, but because of inflation, you're actually losing money. Okay? So if you want better returns, you've got to go to a riskier investment. Now, bonds are considered a fairly low-risk investment, but their returns are often quite low as well. On the far other side, perhaps stocks in general may return the most, but they're also the riskiest. So in general, if you want high returns, you should expect to have to pay with risk. And if you're holding something with a lot of risk in it, and again, we'll define that more precisely in a minute, the returns had better be there to pay for itself. It's not smart to be in a high risk area and a low return area. Like the yellow zone, there are absolute securities in the yellow zone, low return, high risk. That's stupid. Don't be there. You're not getting your money's worth because there, if you're in a high or mid risk area, you should be getting the returns to show for it. There are sometimes opportunities here for high returns and low or medium risk. It's not, as it says here, it's not possible to invest here in efficient markets because people would figure it out. The invisible hand, as they say, the market movers figure it out and the market balances. And so once again, the line is where efficient markets end up tending toward. So you might occasionally find something up here, but it won't stay there for long, basically. So what is risk? Well, there are two kinds. There's risk of permanently losing money owning just one company's stock puts you at risk should the company fail, for example. So I buy Microsoft, Microsoft goes out of business, Microsoft shares are worthless. That's a risk. You mitigate this by diversification. So this is very much in your control. If you have Microsoft and Intel, well, you've mixed your money across those two, then if one of those companies goes out of business, you only lose some of your money. Now, if you compound that greatly, if you own 1,000 different companies, then any one, or even a couple hundred or a few hundred going out of business in a horrible depression or something, won't actually cause you to lose all your money. You would just lose some of your money. Mutual funds make this much easier because mutual funds already own many, many stocks, many different companies. And so that's why mutual funds are much lower, well, generally lower risk than an individual stock, because they tend to not fall so sharply. But it depends on how diversified the mutual fund really is. And we'll go more into diversification later. The point, though, is the more different kinds of things you own, the more resilient you'll be to horrible downturns in the market. Then there's the risk of volatility costing you when you need to sell. So volatility is the price just going up and down a lot, okay? So if it happened to be down when you wanted to sell, it's not that you would lose all your money, but you would lose some of it. So you mitigate this by investing in lower volatility assets as you approach the need to sell, okay? Transfer from high volatility to low on an upswing, potentially years in advance. So let's take this, remember, risk buys returns. So if you're young and you've got a long time before retirement, you probably want to be in higher volatility assets because you'll get higher returns. And as long as you're diversified, then that takes care of this first risk, and you don't have to sell right away, and so that takes care of this risk. So you can afford to be in the higher risk category if you mitigate those two things. As you approach retirement, or when you actually will need to sell, let's say, and it depends on the volatility of the market and your appetite for risk, but it might be 6 months, it might be 3 years, it might be 10 years. But sometime in advance of when you have to sell, you start watching the price chart, basically, over time. And you decide when you think it's a reasonably high period. Certainly not when it just dropped, because it's a volatile market, right? So there's going to be highs and lows. So sometime when you feel like it's at a high point, you could place a limit order to sell at somewhere close to that high point. And then whenever and then you sell and you get cash for it. And then you put your money into something with a lower risk and lower return investment. So you're basically, when you've got lots of time, you start up here because there's high returns up there. And as you approach retirement age, or when you need that money, you move yourself down the line to a lower and lower risk categories. So imagine when you turn 65 and you leave your job and you're going to have to start regularly selling, regardless of what the market is doing, right? You're going to have to buy food and pay a mortgage or whatever your expenses are, regardless of what the market is doing at that point. So at that point, it's inappropriate for you to be in a high risk area because you need to be able to sell stocks or sell whatever security you have without regard to, it's low, so I'm losing money by selling right now. Like, you don't want to be in that position. Now, it's totally possible for you to be in a blend, and we'll talk about, again, next week is when we talk about strategies. But there's a such thing as you could have some of your assets in high risk and some of your assets in low risk in order to kind of try to catch the best of both worlds. So, briefly, a little bit more about diversification. Historically, every single market downturn has recovered and grown beyond, including the Great Depression and Great Recession. Someone adequately diversified whose investments suffered through the Great Depression but held instead of selling low, would have come out on top by the end of the decade. This is super important, because if you're going to start getting into investing and you are watching the price charts, you're like, oh no, it's gone down 30%, sell, I'm going to lose everything. Again, if you're adequately diversified, you're not going to lose everything, historically speaking. Like the life of the stock market, including those two great events, or terrible events over 100 years, the trends show not every company goes out of business at once. And so if you're adequately diversified and you hold on, that 30% drop that you experienced will recover, and you'll get your money's worth, and it'll keep on going. Versus if you sell when it's fallen 30%, guess what you just did? You locked in your losses. And if you decide later, say a year later, when the market recovers, or maybe 3 years later, maybe 7 years later, depends on how long that particular recession lasts, and it recovers, and you're like, okay, great, maybe I'll try it again. And you're out of breath. And all you've got is the cash from your 30% loss. So you buy. So what you did was you rode the market down 30%. And then instead of riding it back up, you stayed out of the market until it recovered, and then you bought. That means you definitely lost 30% of what you had. Versus if you held on and didn't sell when it went down 30%, then you can ride it back up, and at the end, you didn't lose anything. There have been some big names. I don't know if it was Warren Buffett that said this. One of these multi-billionaires had said he doesn't lose money because he doesn't ever sell at a loss. He waits for the market to be higher than when he bought it from, and then that's when he would sell. So something to consider. All right, so we're going to spend some time with the Investopedia Market Simulator. We have I'm going to put the links in the description of the video. So you can join the instruction. This join link is just instructions on how to join a game in general. You're going to also need this text, which I'll put in the video description as well, so that you can join the game. So let's see what that looks like. Okay, so we're at investopedia.com/simulator. You can log in. You might have to create an account. These things are free. Now you click on games, and you'll click join game. And you can type in or copy and paste 101 February 2022 by Andrew Arnott here. Now, if you're watching this video sometime after this game ends, no problem. You can find another game. You can create your own game. Not a big deal. And for you, you'll see a little join link here. So you'll see something like this, join. So you can click join on that. For me, I can't see it because I'm already in the game. So I'm going to go to game. You start with $100,000. This is Monopoly money. And you can, this is a market tool. It shows you real prices with just a 20-minute delay. And you can buy stuff. So for example, earlier this week, I bought Microsoft. I paid $286 for it. It's currently going at $297. So yippee-yay, I bought 10 shares. So this growth of $10, let's see, yeah, about $11 times 10, I made $110 or so. Okay, that's not bad. Although with $100,000, I could have had much more growth this week had I actually invested all of that money. But if I was doing something like dollar cost averaging or something, then I would probably be investing my money little bits at a time, with the idea being that in several months or maybe even a couple years, I'd be fully invested. You can see though, just with the little bit of money that I've put in and the growth that it's had over the last several days, it's estimating my annual return is 7.84%. That's a lot better than a bank account, right? That's 0.05% or something. I'm doing 500 times better than that already. I also have, you can go into trade, and you can say, I want to, let's see, what do I feel like buying today? Maybe I'll buy Apple. How have they been doing? Now again, generally speaking, I don't recommend you buy stocks. They're super high risk, and they're not inherently diversified at all. So it's a higher risk activity. I recommend mutual funds and ETFs that are diversified. We'll talk about diversification next time. But Investopedia doesn't offer mutual funds. They do offer ETFs and stocks. So I have to demonstrate, we have to learn how to use the market tools by buying and selling commodities that I typically wouldn't suggest you buy. That's okay. But so let's just pretend. In the last month, you can see Apple gained a lot and lost some. Well, I mean, a lot. They're scaled so that it always looks like a lot. So you have to actually look at the price, though. It went from 158 to 176. That is a significant jump. And then it fell again, you know. So Apple, the last month, Apple hasn't been doing great. 3 months, again, it goes up and down, but it actually doesn't have a long-term gain. Let's look at it. Okay, this is looking better. Over the year, there's been a long-term gain. That's good. Over 5 years, it definitely has. So, you know, maybe Apple is a good thing to buy. So let's just say. I'm going to buy 50 shares of this. Now we talk about market orders and limit orders. So here's a limit order, here's a market order, and then here's a stop limit. So they don't even offer the stop, the regular stop market order. Like I said, it's maybe more inherently more dangerous. So they offer a stop limit, which is good. Actually, interesting. They're not actually asking for a stop price versus a limit price separately. So I suppose this is just a stop. Maybe they're actually misusing the term because they'd have to show two prices for a stop limit order the way we talked about. Interesting. So now the market is closed right now. It reopens on Monday morning. So if I place an order now, it will not execute immediately. Even if I place a market order, it won't execute immediately. So, and in particular, when the markets are closed, I don't really know what the price will be when it opens. So I want to do a limit order and make sure that I don't spend too much, maybe. So it's trading at $164. I'm willing to pay up to $170 per share. And I want 50 shares of Apple. So assuming Apple doesn't jump really significantly over the weekend, that means I will get my shares probably pretty close to 164. But I certainly won't pay more than 170. Okay, that's the idea. There. So my order is placed. I can go to order status. And we can actually see earlier I bought, I don't even know what INTC is. I forgot. But I placed another buy order yesterday. And so I've got 2 orders that are going to execute right away on Monday. And here's my portfolio again. I just have the one security that I've bought so far. I could place a sell order, whatever I want to do. Now, given this is a game, and it's a public game, you can actually go in and look at how others in the game are doing. You can see I'm actually, my current rank is 2 out of 3, so somebody else in the game is doing better than I am. Sudeep Talk is doing better. Maybe he bought more than I paid for. Or bought so far, or maybe he's more active, or maybe he just got more lucky, who knows. I want to call out, as you switch games, I could go to this one, for example, that this is the huge caveat. I've made this in an earlier class, I'm going to repeat it here. Investopedia is a simulator with hundreds of thousands of gamers, players, okay? Now, if there was a big wood floor room, and you dropped 500 marbles on the floor, and you had a target in one corner of the room, one of those marbles are going to hit the target, okay? Was that marble better than all the other marbles? Is that marble worth watching in the future? No. That would be dumb. Just the law of averages, the crapshoot, whatever you want to call it. Of the hundreds of thousands of players, some will be at the top, and it may be through no merit of their own. And most importantly, past performance is no guarantee of future results, especially when you're looking at players in a simulated game, okay? This player may have started with $100,000 and they've turned their money into, I don't even know what this number is. It's like above $1 trillion. Is this a brilliant person? No, okay? I don't know this person. This person could be an automated computer that just was randomly guessing at orders, okay? The people who are at the top don't stay at the top. And remember, in a game of hundreds of thousands of players, some will happen to get lucky. There's all these different kinds of orders, and someone will rise. So what I don't want you to do, the warning is, Don't look at this and say, oh, I found the gold nugget. I found the brilliant person. I'm going to go to this person. Because check this out. You can go and you can look at this person's portfolio. Okay? And you go, oh, this guy's, look at this. He's winning every time. I'm going to go buy all of these same things. Because these are real prices. These are real companies. Like this person, having made these trades and having this portfolio, did legitimately get this person to this much money, monopoly money. But if you were to go buy all of these now, first of all, the gains are behind us. This person has already realized the gains. There's no guarantee that this will continue to perform as well as it did before. And it probably won't. These are insane gains. The annual return, the return rate on this thing, this guy's getting 321 million% returns annually on this person's investment. That if that were sustainable and repeatable, everyone would be doing what they'd be doing, and you wouldn't see market return averages of 8 to 10%. Okay? So the risk is that you look at this and say, I'm going to do this for real. I'm going to follow this person. He's brilliant. I'm going to go to Fidelity or TD Ameritrade or Charles Schwab or whatever it is you're going to do, and I'm going to, with real money, buy the same things this person does now and in the future. You will probably lose your shirt. Okay? Because again, for all we know, this is just a computer that just randomly was making trades, and this was the lucky one out of hundreds of thousands. If someone was really, really smart in the stock market, they would not be using monopoly money. Okay? They would be using real money, and they'd be making a killing. And they don't. This person would be the richest person in the world with $1,200 trillion, I think is what this is. Okay? So, major point to make is don't try to turn this into real life. It's just a toy to play with so you can get experience managing a portfolio and making trades, so that when you do it for real, you can focus on whether you're making the right trades rather than whether or not you're using the tool the right way. So let's talk about the homework. Try to make some money this week. Join the simulated, use Investopedia, and consider joining the game if the game is still running when you see this video. Several things you should do. Buy using a market order. You could try that both with when the market is open and when it's not. Now, Investopedia in particular, because it has a 20-minute delay in the price feed that it gets from real stock market prices, just so that you can't do arbitrage on it to cheat, every trade has a 20-minute delay built in, even the market orders. So whereas in a real stock market, a market order would execute immediately if the market was open, in Investopedia, it will take 20 minutes to execute. That way the price you see at Fidelity is at the moment you click buy is the price you'll actually get in the simulator, which is 20 minutes later. Okay? but place a buy order with in a market order, and also buy something using a limit order. And I put maker there, meaning, if you recall from earlier today, you should place a limit order with the price set to not execute immediately, so that your order goes onto the order book effectively. Now, Investopedia doesn't show the order book. Fidelity would, so your real brokerage would, and cryptocurrencies do. But I've never found the order book on Investopedia. So you need to place a limit order buy that has the price above or below rather the going price, so that it doesn't execute immediately. So you can kind of get an experience of watching the order book and see it just sitting there until it fills. But set it sufficiently close to the price that it will eventually fill. And then sell using a market order and sell using a limit order. And just for good measure, buy at least 3 different stocks. Now, that's not diversification. That's just the very tip of diversification, which again, we'll talk about next time. But I want, even in a simulator, let's practice not just holding to one stock and having a favorite, okay? We need to be very dispassionate about our investing. So good luck with your assignment, and look forward to seeing more people joining that Investopedia game. Let's get some confidence and trading muscle built up there with the monopoly money before we go with real money. And remember, this is the 5th in a series of Investing 101 classes. So check out the playlist to find the past videos if you missed them and to watch for future ones. I put these out roughly weekly. So if you subscribe to the channel, you will get notified when new videos come out. I hope you find this useful, and I hope you'll share it with your friends and maybe get your friends to join this Investopedia game or one that you help create. Help spread the good word of how to invest your money rather than just have it sit in a bank account or blowing it all on Netflix and coffee. Have a great day.